What is up, guys? Today I'm going to be teaching you about standard deviation. Now, what is standard deviation? Standard deviation is just a confluence that you can use to see where price should go, where it's going to go, where it's also going to bounce, where like the low-hanging fruit is, for example, many things of that nature. And if you draw it correctly and have your overall external bias aligned with standard deviation, it is a very successful tool to add to your trading bag, your trading arsenal. I honestly think it's very important to have and to know because it kind of gives you an idea where price should go. Yogi, stop. Stop. So the first example I'll show you is going to be on the 4-hour chart. It can work on any chart is the cool thing about that. Whoops, wrong button. It works on any chart, which is the cool thing. So overall here, I'm going to show you how to draw it. So what is it? It is the manipulation move higher. So this, for example, we have buy side liquidity. It is the manipulation move up to take this liquidity followed by a break of structure down. So there's two standard deviations. There's many ways you can draw it. You could draw it from this swing high to this swing low, or you could draw it from this one. In the end, it's the same. So we'll draw it from this one. So it's the swing low to the swing high, taking the liquidity. Right here, we agree that this is the buy side liquidity being taken. Then we have a clear sell-off that breaks structure, aka market structure shift. Now, what is another rule of standard deviation? Another rule is this is the range you expect it to go to right away. You expect it to sell very fast at this 2 to 2.5 range. Then, after it hits the 2 to 2.5 range, you expect it to go back to discount or premium of the sell-off leg. So, for example, this whole entire leg right here is our sell-off to the 2.5. So we are going to expect price to retrace to discount of this leg before continuing down to the 4 level, as you can see. This is one of the best standard deviation examples in the market I've seen in recent times, especially how it reacted. So just to show you guys something that's very cool is I told you that once you're at the 2.5, sometimes you expect price, or most of the time you'll expect a retracement after that. You'll expect a retracement to equilibrium of this sell-off. But let's look at what aligns with this sell-off. A daily fair value gap. You see how you align these things together to make it even more obvious? So if you know the standard deviation is supposed to bounce at the 2 to 2.5, and you also have a daily fair value gap in your favor, it's a perfect place for price to bounce. And now this right here is another standard deviation. We can check it out. Why? Because it is the internal high being swept, the buy side liquidity being swept right here with displacement down. Let's see where it lines up. I don't even know. Oh, right where price starts to consolidate again. That's what you notice. And when that 2 to 2.5 level gets hit, price will start to consolidate. Price will not be as efficient as it was on the way down. Let's see. Well, I guess it would be from here. See if we get back to discount. We almost do. Not fully, but of this whole leg, we're still in there. We touched it a little bit before continuing lower. Okay. So this was an example on the 4-hour. Now, does it make sense how you measure it? You measure it from the swing low to the swing high of taking the liquidity, and then a break of structure follows. You can't measure it if there's no break of structure following it. If this candle came down and then went like this, you can't measure it because it is not a clean market structure shift after the sweep of liquidity. I'll show you an example on the 1 minute here. Now, for example, this is the 1 minute and how you can take a trade off of it. So if you were to take a trade here, you know, you're watching this and you have your standard deviation marked out. Why? Because this is your buy side level. This is your swing low to manipulation move higher to take that liquidity to then sell off. You get the market structure shift right here, so you measure it from these to these. Now you expect price to go to this 2 to 2.5. Look how efficiently price sells off to this 2 to 2.5. That would be your low-hanging fruit. This would be the area that you would want to sell off most of your position. But as you can see, most of the times it will line up with a key area too. As you see, the 4 level lines up down here. This doesn't really line up with anything. Maybe there's a big imbalance here. I don't want to zoom out because it'll mess it up. But that is just another example of how the standard deviation. If you have standard deviation within the trade you are taking, there's a higher probability it'll play out. I believe so personally. Because most of the time when you have the standard deviation move like this, there will also be an SMT right here, which gives you even more confidence that price is going to come here. Now you could even measure, whoops. Hi Hank. You could even measure it from here. If you were to measure it from here on a lower time frame, this is the 1 minute. I don't have lower time frames. But if you were to measure it on the lower time frame, look where it lines up. It lines up right to this sell side level right here. It just depends from what time frames. Now this is a higher time frame level and it lines up down here. It's just a time frame thing, and I can show you a couple other examples in my OneNote. As you can see here, you have higher time frame liquidity swept, then internal gets swept with the sell side down. You get a clear market structure shift right here. You measure the standard deviation, it aligns perfectly with the original consolidation of this market maker sell model. Sell straight off there cleanly. Yeah. So that is all I have for you guys for standard deviation. All it is a guidance of price to where price should go if you measure it correctly. Now, how do you measure it? It is liquidity being swept, a manipulation move. So right here, for example, my bias would be bearish, and this manipulation move would have been a bullish manipulation move for an overall bearish move. So you have a manipulation move to a higher, you measure it from swing low to swing high, and then you have to have the break of structure or the market structure shift following the sweep of liquidity. If you don't have the market structure shift following the sweep of liquidity, it is an invalid standard deviation. So I can draw one for you right here where, so you say you had this, boom, 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 boom. This would not be standard deviation, and there's many reasons why. Because this did not take this liquidity. For example, if this was standard deviation, it'd be like this. Boom, 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 boom. It would be like this, and where would the standard deviation be? Let's draw it out. Well, clear you have your sell side. It can be internal or external. Usually it's going to be a more internal thing. Sell side, you have your market structure shift. So you measure that whole manipulation move down to find your price target, if that makes sense. Do you see this? Sell side taken, market structure shift to the upside, measure that swing high to that swing low, following the breaker structure to then guide where price is going to go higher to this level right here. It is a very good tool to use. If you guys enjoyed this video, please like and subscribe. I really appreciate all the support. Also, feel free to join my free Discord, link in the bio. If you have any questions on standard deviation, any questions on any ICT concepts or smart money concepts like that, I'll be there to help you. Thank you so much. Have a great day.